India's growth story converging into India's growth trajectory or not. You can debate about large cap, you can debate about mid cap, you will debate whether Ambit coffee can will work, Ambit emerging giants will work, Ambit 10x will work. You don't know. You'll debate value strategy will work, growth strategy will work. You can debate. What you can't debate is India's growth, which has happened in last 2 to 2.5 decades, predominantly after LPG, liberalization, privatization, and globalization. But in last 9.5 years, we have all seen hyper optimism. Is it real? We have one panelist who's data driven, we have one panelist who's the father of investing, and we have one analyst and one speaker who's cautiously optimistic and one who's optimistic. So interesting conversation, interesting debate. What has changed in last 9.5 years? From my little understanding, if I have to summarize, it's in 3 very simple things. Number 1, weighted average cost of capital for the country has gone down forever. Jan Dhan demonetization. You are seeing that PSU banks did extremely well. Is it only to do with the PSU banks? Maybe not. The cost of capital has gone down. Second, digitization, enabling democratization of capital for startups, for investing. And last but not the least, and I will quote from Manu Smriti, one Sanskrit shlok. And it's very interesting because it sums up where Bharat is today. And it's like this. Sarvam parvansham dukham, sarvam matma vansham sukham. Anything which is not in your control gives agony, unhappiness. Anything which is in your control gives happiness. Is it true? That's what we are going to certify with data points from our esteemed panelists. My first question to Bharat Bhai. Bharat Bhai, you have decades of experience. But what has happened in CY23 and CY22? Unprecedented European conflict, Israel-Hamas war, interest rates rising, unprecedented levels and at unprecedented velocity. What do you see is a short-term impact. Markets have discounted all of it and markets have ignored all of it. What do you see the short-term impact of it in next 6 months, 12 months when we have 2 major events, Lok Sabha elections and presidential US elections? In that context, where do you see markets heading and why?
No, that's simple to answer. 6 to 12 months is too tough to predict, and I have zero capability to make such assertions or predictions. And therefore, I'm happily reconciled to the fact that near term is something that I'm oblivious and blind to, incapable of conjecturing or perceiving. And to that extent, that is the flux of the life that you forever live in. That near term, always things will happen, and some pleasant, some not so pleasant, and you learn to live with that flux without really tormenting your mind. But the question that you did not ask, but I'm seeking to answer, is on a more medium to long term. I think we are at a cusp of one of the most defining moments, and sometime in future, probably this will be judged as a moment in history in making. I think the country will grow, not only grow at a rate which is superior to the past, but superior to any meaningful comparison anywhere in the world. But even more importantly, the rate of growth will be a very long-term, durable, predictable kind of a growth, and therefore much more valuable than in the past. Thirdly, the quality of the growth is much better. capital efficiency, return on capital employed, return on equity, indebtedness of the corporate balance sheets has come down, and generally the solidity and the strength of the businesses. Many of these things imply that it will not just be the growth which will be the harbinger of the value creation, but the quality of growth, which is an important addition to that rate of growth, is an additionality on a long-term per annum kind of annuity. And in the context of all of these, while debates forever go on about Indian market valuations and all that, which most of the time I fail to understand really, but in my opinion, overall, in the context of the strength of the growth and the quality of the growth, markets are reasonably valued, not unduly cheap, but by no stretch of definition any meaningfully expensive. Therefore, we are on a beautiful long-term game. And I believe the wealth creation ahead will be unprecedented. Probably na bhuto, na bhavishya. That kind of an unprecedented period is lying ahead. And when I'm saying the longer term, I'm not talking of 2 years and 3 years and 5 years. I think 10 years and 15 years and 20 years and more kind of unprecedented compounding of a high order which transform individuals, businesses, and countries. I think we are slated for that. That is what I believe. And some of the factors that you alluded to are at the cause. When reforms, but there are many more reforms which have occurred. When reforms are few and far between and shallow, the best outcome can only be arithmetic sum total of them. But when reforms are deep, are many, and keep occurring over a period of time, like in last 9 to 10 years, then they acquire an ecosystem of their own. Then they become a geometric force multiplier. I think the country is at that stage of the geometricity kind of a multiplication. The growth will reflect into the cash flows and profits of the businesses, in turn into the wealth of the owners of these businesses, and finally into the portfolios of investors who are steadfastly focused on long-term, durable, superior, wise compounding.
Thanks, Bharat Bhai, for these convincing thoughts that India is going to grow and India is going to grow handsomely, and thanks to the reforms, and they will keep coming by whenever Bharat needs it. Thanks. Devina, next question to you. You have seen many market cycles. You have seen many decades. If I have to ask you your opinion on comparing the last decade, the last 2004 to 14 versus 14 to 23, 9.5 years, which one will you choose? Don't look at the markets, look at the fundamentals. Which one and why? And what can be done further? Maybe after 24, obviously.
Right. First of all, I will not fall into this trap of trying to compare, because this then becomes a political question rather than an economic question or a market question. So let me just give you some perspective. Since we are talking history, let me tell you, a few things. One, of course, we try to conflate or say that what's happening in the economy will reflect in the markets. That doesn't always happen, since people here are there for the market. So if you look at China, for example, the market made its high in 2007, depending on which index you look at. After that, the economy went up 7 times without the index taking out its high. So first of all, separate these two things. So as far as the market is concerned, it's a very interesting history. We all think that equity will compound returns at 15-16%, because that's been the long-term returns in equity. But all of us know this in theory, that equity markets give volatile returns. But when you look at, when you're living through even a slight bit of volatility, as we are doing now, it certainly becomes somewhat strange. And the market returns vary not just from year to year, but very dramatically from decade to decade. So If you look at 1980, for example, if you'd invested 100 rupees, by the end of the decade, you would have 700 rupees. In 2010, if you had invested 100 rupees by 2020, it would have been only 230 rupees, which means that the compounding was less than 9%, barely above fixed deposit rates. So that is what has created the room for the market to go up. So even after this run up post-COVID lows, you are not above the trend line, you're still much below the trend line. The risk of a crash comes when you are far above the trend line. But as far as the economy is concerned, just if you compare, let's say, today's GDP number with the pre-pandemic 2019 number, we haven't shown a great deal of growth. Number one. Also, the economy is really, two different economies. So for most of the people in this room, it will be that my friends are buying cars, they're buying houses, the economy is doing very well. But the fact also remains that 80 crore Indians need free food. Every time there is like one job, there are like lakhs of applicants. So that's also a fact of life. So we have to, on the economy front, there are things which we have to focus on. For one, we all think of the demographic dividend, which means that India is a young country, which it is. But demographic dividend also has three components. It is the percentage of population in the working age, into how many of them are employed, into the productivity. We only have the first, we don't even have the second component. Youth unemployment still remains worryingly high. So those would be my concerns. So, while, the headline GDP number is one thing, but for it to be sustainable, lot of things have to be in place, because remember, on the spreadsheet, whether it's for corporate earnings or for GDP, very easy to put in the growth rates. But 6% compounding every year for decades on end has only been achieved a couple of times in the history of the world. So it is only Taiwan and South Korea which managed to do it for a few decades, and China which has been able to do it for longer. But it is not a given that you will be able to do it unless you put all the building blocks in place.
Thank you, Devina. So a little bit of cautiously optimistic approach. Rajni, the question to you. There have been reports from IMF, there have been reports from World Bank that India is poised to become the third largest economy, defeating Japan as well, superseding Japan. We are seeing global headwinds. We are seeing one after the other chaos outside India. Do you still think, is it achievable? What are the building blocks, things which have happened in the past, but what do you see can drive this momentum and can take India to the next level?
I'll talk about the building blocks. Firstly, I would talk about demographic dividend. Yes, we have this benefit of having a large working age population. Though I agree that there are concerns as to how productive that working age population is, whether we are able to generate enough employment opportunities, are we skilling them enough to be employed productively? But the point is that we have this opportunity. We need to act smartly to tap into this opportunity, because we have this opportunity at a time when most developed economies, in fact, most major economies, including China, is going through a phase of aging. So it's very important that we tap into this opportunity, and in many ways we are. For instance, I would like to talk about the success that we have made in ITS sector. We have this large STEM population which is really helping us grow. In fact, the GCCs also, the Global Capability Centers, we are seeing that segment also growing fast. But yes, I agree, at the same time, we have a large chunk of population which needs to be adequately skilled to be absorbed in the manufacturing sector. Some of the other points I'll highlight is the big consumption market that we have. India has a high consumption to GDP ratio of around 55%. And now we have this young working age population with high aspirations who are willing to spend on credit. So we can see a consumption boom happening. But again, here we need to be cautious, because we need to ensure that this consumption boom happens all across. Like right now what's happening, like what Devina mentioned, right now what's happening is that it's one income segment. the higher income category, where we are seeing a big jump in consumption, whereas the lower income category is still very cautious. But the point that I want to highlight is that this opportunity is there again. Then, of course, digitalization, which you spoke about, that's a big jump we have made there, and we have to capitalize into it. That will lead to financial inclusion, this whole rise of startups that we are seeing. So that's another positive. In fact, I'll also mention that physical infrastructure, which has been India's weak point, that is also improving. There's a lot of progress that has happened in transport infrastructure. So that should hopefully result in our logistics cost going down, because that has been one pain point for us, that our logistic cost is very high. Then I would say even other factors like our financial system is in good shape, good health. So I feel there's a combination of all these factors which should help us record good growth going forward. But definitely we need to be cautious because there are a lot of hindrances. But yes, there is a big opportunity. World is looking at India because of this whole China plus one strategy. The geopolitical equation has changed. So there's a lot of expectations from India. We need to just act smartly and quickly to grab this opportunity.
Thank you, Rajni. So picking up where all three of you left, consumption demographics is the theme which is coming, long-term demographic or demographic benefit which is gonna accrue to Bharat, which is gonna accrue to India. So Tirthankar, question to you. The latest RBI report almost said that this consumption which is happening out of leverage, out of borrowings. And the interesting part is 1/3 of that is actually coming from so-called tourism or travel, as well as from home renovation, which essentially means discretionary unsecured borrowing, number one. Number two, we saw that in last 2 years, public Capex or public spending has jumped by almost 60-odd%. Private sector Capex, missing. What's happening? Is there something to be worried about that credit is happening on unsecured basis? Private sector Capex is not happening. Is this consumption gonna be sustained? Already we are at 55%. Some reports estimate by 2030 we'll be at 60%. Then where are we gonna be? Another US, where the debt to income for the household is gonna be 1.4 to 1. What do you think? And is it sustainable?
So, first of all, thank you for the opportunity, everybody. Where should I start? Private corporate Capex. It hasn't picked up. Why would somebody put up Capex? Think about it. We all are investors. We all are, like in some sense, either direct or indirect. And then we expect our companies to put up enormous amount of private corporate Capex. And when they don't, we get worried. Here's the question. I mean, they will put up Capex first when there is demand. No. Second, when there is demand. First, if their balance sheet allows it. We've had something I don't hear these days called the twin balance sheet crisis. It was there. It started around 2014-15 or so, when we had a peculiar problem. Our banks had too much of NPAs and our corporates had too much of leverage. So neither could the banks lend to corporates, neither could the corporates borrow from banks. Luckily, after 10 or so years of this twin balance sheet crisis, our balance sheets today, and I mean corporate balance sheets, are in a much, much better shape. Overall leverage has come down significantly, about 30-odd percentage points. And secondly, NPAs of banks are in a much, much better shape. And let's understand where these NPAs frankly came from. Obviously, twin balance sheet crisis from corporates. Where does that leave banks? Banks are obviously, once bitten, twice shy. So one of the things that you see over the last 2 years or so, or 3 years or so, is where are banks lending? Banks are lending to another safe place. Banks are lending to households. So you lend to essentially only 3 places: government, corporates, and then households. Government lending, our SLR requirements are 19-odd%. Banks have much more of their money stashed to government, so they lend to the government. Banks lend to households. Households are deemed safe. This is why we are seeing a lot of retail credit sort of happening. In fact, last year, out of the incremental credit, nearly 70% was retail. And that brings me to Siddharth's point. Why are retailers borrowing so much? Why are households like us borrowing so much? You had, GDP, which was around 8% in 2016. By the time we entered the pandemic, it came to around 4.2%. What's happening? Incrementally, you're not making enough money. But consumption remains strong. So what do? You end up hitting into your savings. Sometimes you even take leverage to hold your savings. This is the phenomenon that we are seeing here. So from banks' perspective, lending to corporates has been coming down. Lending to households has been going up. Households are consuming in spite of lower incremental growth of income, and that's why they are dipping into their savings. And that is what essentially we saw this time. But what's the silver lining there? When, corporates don't put up Capex, government puts up Capex. Government, and that's where you said, overall corporate government Capex has gone up almost 60%. If I look at, government budgets today, 22% of the overall spend of about 45 lakh crores is just Capex. Now you might argue some of them is to states, some of them is for on lending, not all of it is for direct spend, but it is the highest number we have seen in several years. If you look at the government Capex to GDP, government Capex to budget spend, upward trend like this. From 10%, even 12 years back, now it's at 22%. If you look at it from a GDP number, it's about 3%. I'll give you, so these numbers may not resonate with the audience. Let me tell you one thing. All of us travel in electric trains. Now, when I grew up in Rajasthan. There was no electrification there. I went to Chennai, there also. I mean, when I used to come to Mumbai to study, part of the journey was on diesel trains because there was no electrification. Here's the surprise. Since independence, we've had around 63,000 kilometers of railway tracks. This is the railway track, the entire route kilometers that's been there in the country. 90% of it is today electrified, 90%. 54,000 kilometers out of that 60-odd thousand kilometers of total track in the country. And by track, I mean, if you go from A to B, all the tracks there are counted as 1 point. So, 20 kilometers, even though there might be 2 tracks, 3 tracks, 4 tracks, it doesn't matter. Route kilometers only 20. 90% is electrified. But here's where things get more interesting. By the end of the year, this number will reach 100%. India will be a 100% electrified country. This is the transport infrastructure spend that Rajni was talking about. Imagine all of India electrified. 6,000 more kilometers of electrification to be done in the next 6 months. What was the electrification even 10 years back? 1,000 kilometers a year. That 1,000 kilometers went to 1,100 kilometers, 1,200 kilometers. Pre-pandemic, we were doing 3,000 kilometers a year. This year, we will do, if all goes well, 6,000 kilometers in 6 months. That's the kind of spend. I don't even have to go towards the number of airports that have come up. The transport numbers that we are seeing in airports. India is, every country saw airline reservations move up after the pandemic. Of course, everybody was moving out. Everybody was, there was revenge travel, revenge tourism and so forth. But no one saw numbers like India. Numbers went up 4x. Numbers went up 90% for domestic and international travel. So that's the kind of jump we are seeing, which is made feasible by the amount of transport infrastructure spend that the government has been doing. So to answer your bigger question, do I expect private corporate capex to come up? Yes. Private corporate capex at some point will reflect the second order condition that I said. First, balance sheets are good. Now, if consumption holds over the next 2 odd years, you will see capacity utilization numbers come up, and then you will see private corporate capex come up as well. Look at cement numbers, look at steel numbers. They've already started picking up. That's the story. So I don't see that.
FY26, you are saying that the private sector capex should start picking on your.
No, I didn't say FY26.
FY27?
I'm saying that. No. Sooner. I'm saying private corporate capex depends upon the second order condition of consumption growth staying. At this point, remember, Rajni also mentioned that rural spend is sort of slowing down. So there are still some questions on consumption at the moment. But if they see this consumption holding up, I have no doubt that private corporate capex will improve.
Just to, so one very interesting thing, you said that the consumption remains very strong despite the income levels dropping. Yes. Can you elaborate a little bit on that? And what do you think then will consumption sustain? Because in other words, then the unsecured leverage will increase.
I think that's a fair point. So what I meant was income levels came down by growth. They did not come down actually. So you were growing at 8% in 2015, By 2019-20, you were growing at 4%. This does not mean your income fell down. It just grew less compared to the previous year. But consumption trends are also behavioral trends. So some of the things we have seen in the last several years are access to technology, access to digital public infrastructure that my previous panelists also spoke about. These transport or translate into behavioral trends of spending. Today, we don't think twice about spending a 30,000-40,000 rupee phone. We would not have done this. This was not a part of our consumption basket even 10 years back. So, we see, CPI basket of 2012, we don't see mobile phones. So, I don't see consumption coming down from that sense.
Thank you. Bharat Bhai, taking your longer term perspective, because obviously all of us are buoyant and all of us are optimistic. Maybe some are cautiously, some are more positively optimistic about Bharat. Which sectors do you think will lead the growth? Because it can't be equi-weighted. Which sectors in your mind is going to lead the next trajectory for this decade or for 10 years from now or till 10 years?
Before I answer that on the previous segment, I'll just make an additional comment. Slightly more philosophically and a little bit in a more illustrative way as well. You see, the pure cheapness without growth is a very self-limiting exercise. But growth without quality and the superior quality is actually recipe for mediocrity, if not destruction. And therefore you need growth and the quality and both of them. But if that is not at a sensible price, then it is an exercise in self-reduction. Therefore you need all of the three. And I believe India finally is at a point where we have a picture of a long-term growth, sustainable growth, predictable growth. All of these are important because any growth which is not compounding growth has a limited value. A growth which is not very predictable again has a limiting value. And therefore we are at a point where predictable, long-term, solid, compounding kind of growth is there. The quality of growth comes from deleveraging, enabling other reforms and measures that have happened, improved capital efficiency, both return on capital employed, return on equity. And finally, one other thing that is important from a valuation perspective that we need to keep in mind. If we see the behavior of the markets in India over decades, the past decades, it has been relatively more shallow because the political economy did not have long-term visibility, and therefore it reflected in relatively shallow behavior of the investment participants in the markets, as well as in a lower valuation systemically of the markets. When there is a greater confidence and belief about the future, I think systemically those valuations improve. And very importantly, the behavior of the investment participants in the markets takes a better turn. Therefore, I believe many important fortuitous factors are now combining together, and where growth, quality, and reasonable value, all three are combining together. But that doesn't mean outcomes are assured. Outcomes still need to happen. The policy framework continues to need to be right. It needs to be executed well the way it has been so far. And we need to see the continuation of both sound policy and sound execution as has been the case so far. So long as these happen to be in place, I think there are more reasons to be positive rather than negative. Cynicism and negativity are very seductive, but I think today probably is a time for greater optimism and faith, both in the businesses as well as in the markets. In terms of the sectors, what you talked about, my investment approach and thinking is not about macros or about themes or about sectors. I prefer to be bottom-up investor, and I prefer to think about each investment in its own merit and demerits, and valuation, and that is the way I think about investing. But since you have asked the question, I think in a rising crescendo, many things do well, and India is one of the much more diverse economies than most other economies around the world. And certainly, even among economies of size and substance, India is materially diversified economy across the board. I think manufacturing ecosystem which is being kicked in has long-term phenomenal ramifications. Manufacturing ecosystem through PLI takes some time because manufacturing by its very nature would take some more time to develop as a kind of a multiplying force as an ecosystem. But I think ingredients are in place. There is a very credible chance that many areas of manufacturing, some new, some old, specialty ones, will emerge as powerful drivers of opportunity in the country. I think lending per se and financial services in general all have a lot of opportunity. Lending because India is under leveraged and under lent, growth will demand that lending. Financial services because lots of opportunities abound in the growing wealth of the country to render services to. I think even traditional businesses, which are, let's say, like cement, which is linked to infrastructure and real estate and growth of all of that, would do wonderfully well. I would also think consumption will do well. The character of consumption will change. It may not be just the staples of the toothpaste variety, but aspirational consumption, luxury consumption, discretionary consumption, all of them have a good chance to do well. Infrastructure related capital goods and services built around that, again, many important major opportunities abound. Health related, again, significant opportunities in a country which is rising and more conscious about guarding its own health. I think the most important question probably is not which sector and when. It is about recognizing opportunities as they come. Therefore, rather than predicting what will do well and what will happen as well and riding on the theme, I'll prefer to be a keen observer, watching what happens. And whatever happens, you want to align and adapt and benefit from that. That is my approach and understanding.
Thank you, Bharat Bhai. So good approach to the sectors and sunrise sectors, as Bharat Bhai said, healthcare, consumer discretionary, and everything which is propelling the growth. So thanks, Bharat Bhai. Devina, one sector which Bharat Bhai mentioned is manufacturing, and we have seen that last 10 years versus this, we have seen humongous growth in the manufacturing, whether it is defense, whether it's textiles. And a lot of credit goes to the PLI scheme. Now, PLI scheme is obviously going to last only till a point. What happens after that? Is it sustainable? Has PLI enabled the building blocks for manufacturing industry in India? And what's happening in China? Is it actually manufacturing shifting from China to India? And number three, you spoke about China growing rapidly, right? 6%, crossing 6% continuously. One of the factors was beyond consumption, was manufacturing. If India has to go on that path of crossing 6% continuously, longer periods, is it sustainable? PLI.
Okay, so as you said, the PLI incentives are there for a limited period of time, and that's a theme that we have been looking at. But unfortunately, and I'm really sad about this, that if you look at the gross numbers for manufacturing, they are not inspiring at all. I mean, if you look at India's manufacturing as a percentage of GDP, it is now in the 13% range. When was it last in the 13% range? In 1969. So for over 50 years, you have been far above this number as percentage of GDP. About 10 years ago, I think you had a 5-year run when it was 17% plus, except in 1 year. I think 6 years minus 1 year was 17% plus as percentage of GDP. So this is my worry, and this ties in also with the employment, because mass employment gets generated with manufacturing, and your manufacturing has actually been falling. Even the employment numbers you see are showing growth in agricultural employment, which, you know, every student of economics page 1 knows this disguised unemployment. The country progresses when people move out of agriculture, not into agriculture, when you already have such a large population there. So those are concerns. I hope we get our act together. On China plus one, actual opportunity was when the world was having a party from about, roughly from about 10 years ago to 5 years ago, when the world was growing at a tier. Vietnam, Bangladesh, everywhere people were running out of capacity, and our exports had the worst run ever in the history. So, I mean, we have to, their opportunities are there in the world, but we have to capitalize on those opportunities. That people are looking for manufacturing centers outside China. You have to go and grab that. And, the best time to do that was yesterday or 5 years ago or 7 years ago. But you still need to go and do that. So just as it was mentioned that ITES services have been a success in India, manufacturing could have been a success also. It can still be a success if we actually make the moves. In terms of where we invest, so as Bharat said, ours is also a bottom-up system, though we are, we use a lot of artificial intelligence and machine learning to do the sifting, so that everything is on the same basis from the 700, 800 stocks that meet our liquidity criteria and 1,000 crore plus market cap criteria. And as it happens, in the last 2 years, our highest overweight sectors has been industrials and capital goods, and which is something people woke up to more in 2023, but we started in October 2021. In fact, the question we ask every quarter is that story over? Till now, our systems have not signaled that story is over. So obviously, you are making a bet on some of those things. And also, I mean, lot of the manufacturing issues that have arisen have not necessarily been in the listed companies. So the economy and the listed universe are two different things. So there have been a couple of big jolts to the non-listed, non-large corporations, the SME segment, which has actually decimated a lot of companies, and maybe the gross manufacturing figures are reflecting that. So, as I said, economy, market, listed companies, they are all different things. So, don't extrapolate always on what's happening on the economy. So there are, definitely manufacturing sectors we like to invest in. But as a country, there are concerns. This, as I said, is the historic low in manufacturing for us.
Did you participate in the defense run, in EMS run, all these textile run? These are all manufacturing driven, right? So did you participate as an investment thesis, as an investment philosophy?
We don't believe in thesis because we don't believe in stories. See, it's a very seductive to tell stories. And as human beings, we are very prone to tell stories because that is what makes us human in a sense. The one thing which is common across all human civilizations, across ages, across geographies is stories. That we communicate through stories, we learn through stories, we respond to stories. If I tell you today, 5 lakh children in Thane district are malnourished, you'll turn the page. But if I show you a photo or video of one family or one kid who's starving, you will, respond to that charity appeal. So that's the seduction of stories. So as an investment manager, I make sure that I don't fall for stories, which is the whole reason to have a system in place. Because the system prevents you from just storyfying whatever you're buying and saying this is great and therefore I'm buying it, the brand is great, the management is great, this business is great. But if I look at my best performing stocks in 2020, in 2021, in 2022, they are different. And if I had bought into this story, like for example, at one point you're participating in the whole chemical thing, that these are the greatest companies ever, you wouldn't have got out in time. So as I said, 2 years ago, we made a bet on industrials, but I have no illusions that I will hold it forever or those companies have some some magic which will never go away. Because no matter what the company is, no theme runs forever. I mean, this is something I repeat. No theme means no geography, no asset class, no sector runs forever. Even if it's a predictable business, the stock market run is never predictable. So at times, yes, to answer your question, in our portfolios, we have held defense stocks and some of the other manufacturing stocks, but doesn't necessarily mean that, we are buying into a story, because as I said, we are anti-story. So, the whole system is based on that you should be able to buy things without bias, without noise, both of which we as human beings are very prone to, because it is hardwired into us by evolution. So unless you put a system in place to eliminate that, you will fall into that trap. And which is why I didn't even start a PMS till I had a system in place. I had a license for 20 years before we started a PMS, because I wanted something which had replicability, which had some foreseeability, which had some consistency. And now 3.5 years, we've been top not just on returns, but risk-adjusted returns. So that comes out of a system. But I mean, as I said, we bought things, but we don't necessarily buy stories.
Thank you. Rajni, for you, the question is, which is hot in the market, US 5-year, US 10-year 5%, and Fed's commentary higher for longer. Obviously, election year is round the corner for both US and India. Inflation is high, inflation is not coming under control. In India also, in the interim it was surging, but obviously for different compulsions, the interest rates are not rising. What's going to happen? And will it compromise on the India's growth story? Because if interest rates in the West remains higher, why would I invest into risky assets if my US treasury is giving me 5%, 6%? Why would I invest? So you're constantly seeing FII challenges as well. So your comments on both FDI as well as FII.
So coming first to India interest rate story. So India, if you look at what RBI has been targeting, inflation has started coming down, but it has gone below 6%, but RBI is reiterating that we are looking at 4% target. And hence, even while they are not hiking interest rate, they have been very cautious. So given the situation which we are expecting will pan out in the next few quarters, what we are expecting is that inflation will remain around 5 to 5.5% CPI inflation. Hence, we feel that RBI will remain cautious. We can expect rate cut to start happening from the second quarter of next fiscal year. Now, if I talk about what's happening in US economy, so in fact, if you see most of the central banks, they did a mistake in their ability to accept how humongous and how risky the inflation was when it started going up post-COVID. Most of them felt that, it's temporary and because of the supply bottlenecks and it will settle down. But it turned out to be a bigger demon, I would say. And now when they've recognized and they kind of started acting late to that, now they are being very cautious. So even in US, inflation has started coming down. But given that it remains above their 2% target, and given that the economy is still showing healthy growth numbers, not as sober numbers as was anticipated in the beginning of the year, Fed also remains cautious. And they have been indicating that it's going to remain higher for longer. But we can expect Fed also we can expect that rates have kind of peaked, maybe one more rate hike, but we expect rates them also Fed to start cutting rate from next year. So that's on interest rate. Basically, our view is that it has peaked and now we can expect it to start coming down. It's only a matter of when, like 2 quarters, 3 quarters, but yes, the rates have broadly peaked. Now coming to your question on FII, yes, that is a concern because we are seeing FII outflows with US indicating that rates are going to remain higher for longer. But I think we expect US rates also to start going down in say 6 to 8 months. Second, we should expect that if the fundamentals of Indian economy turns out to be better, we have been discussing that There are challenges, but at the same time, there are some positive aspects, there are opportunities. So if we are able to grab into those opportunities, and we are in a period when Indian economy, even if we manage to grow by 6%, more than 6%, we will be one of the high growing and stable economies, because we are at a point when most major economies are slowing. China, which was recording growth of 8 to 9%, is expected to go down to around 3 to 4%. So in that sense, I think India offers a relatively better economic scenario.
Thanks. So you believe that there can be 5-6 months of challenging times ahead of us, because till the time the interest rate cuts, as you mentioned, that it's going to only happen in the second quarter of FY25. So thanks. Tirthankar, question for you. We are seeing humongous retail participation, futures, options, derivatives. Now exchange is also going to increase the timings. And a lot of people believe that first timers can make tons of money. What's happening, as in, you saw COVID changing the education system for the investors. At the same time, there are a whole lot of people, as you mentioned, the income levels are dropping. Are people there to make quick money, and will it sustain? Because if people from FDs move into the futures and options, what can happen? What are exchanges doing about it?
So first thing, incomes are not dropping. Incomes are not dropping at all. I have to repeat. We were growing at 8%. Then before the pandemic, we started growing at 4.2%. At the moment, this year, second quarter growth was 7.8%. Incomes are not dropping. There is stress in certain areas of the economy like rural sector, but as my fellow panelists have been pointing out, there are several places which are positive, and ultimately India stands out in the global economy as a beacon of growth and hope because of its growth differential. If you look at the IMF latest WEO numbers, India's numbers are north of 6%. RBI's numbers for FY24 are 6.5%. RBI's inflation target is 5.2% for end of this fiscal. That kind of growth with that kind of inflation, there are not many countries in the world. So growth is not dropping, first. So then what about retail investors? You see, three things have sort of changed in the last 3 to 4 years. What has changed? One is this that I hold in my hand. This is a computer. It's a very powerful computer. It has 8 cores. Most of your phones have 8 cores. And it allows me to be connected with the world as if I'm sitting at my desktop. Practically everything is available. I have fast internet connectivity, very reliable internet connectivity, 4G, 5G in general. 2 things. Third point, we have Aadhaar. We have a system where my identification is known to anybody who wants to assess it. So that allows me to connect and open a bank account, a trading account, a demat account in the time which is a fraction of what it used to be. So two decades back, when I opened a demat account, I had to sign 15 places. Today, I don't have to. You guys can open a demat account in this presentation itself. Now, when these 3 things all come together, and then you have an event like the pandemic, you suddenly start seeing interest in the markets. During this time, one of the things that you pointed out earlier in the presentation was that our weighted average cost of capital has come down. Now, weighted average cost of capital has come down on both equity as well as debt. Importantly, that means that retail savings and the returns that they were getting on FDs have been coming down. What does that push you towards or nudge you towards? You want to look at other asset classes. The amount of interest that we see in the markets today or over the last 3 years has also been a function of lower returns on other asset classes. So these are the various nudges that we see as an exchange push retail investors towards the markets. They're basically looking at other asset classes. And they're not coming to the markets directly alone. If you look at the SIP numbers, for instance, 3 years back, they used to be 4,000, 5,000 crores a month. Today, the number is about 13,000 crores a month. There's a significant amount of retail investment that's coming into the markets from an indirect channel as well. So these are some of the points that are, pushing people towards markets. Now, how far is it? How far have they gone? If I look at overall household savings, you divide them into financial savings and non-financial savings. Part of that financial savings is also shares and debentures. If you look at the RBI figures, that number is 2%, 2.5%. 2.5% of overall savings today. So for us, when we look at numbers like 13,000 crores a month, 14,000 crores a month, these numbers are huge. I'm giving you the GDP number of 300 lakh crores, 300 trillion, out of which household savings are about 30%. So households are saving about 100 lakh crores every year. Now, out of that 100 lakh crores, how much money is coming into financial markets? So the way we see it is, you have to be there for the long term. There is a long-term behavioral trend, as I mentioned earlier, that's coming into our markets. There is the India growth story, and there is the Indian investor or the Indian household who's turning into an investor. So I began looking into the markets in the late 90s. For the longest period, what percentage of India invested in the markets? 2%, 2%, 2%. All strategy meetings that we did, 2%. In the last 3 years, this number has gone to 3%, 4%, 5%, 7%. The number of unique PAN accounts, not demat accounts, unique PAN accounts, pre-pandemic was 3 crores. In August, NSE's number went to 8 crores. The last 1 crore people came in 8 months. That's the amount of interest that's coming into the direct channels. I'm not even beginning to speak about the mutual fund channels, about which the one indication I gave was SIP. So we see it as a long-term trend, which is basically reflecting the promise that the Indian economy is basically showing, and the move or the nudge that other asset classes have sort of given. Now, when interest rates are going up, now we've had 250 basis points rise on the policy rate. We've seen deposit rates slowly start creeping up. So the opportunity cost of equity starts moving up for the retail guy as well. He suddenly starts seeing higher figures on the FD numbers as well. Also, we must look at that the last 3 years have not been a bear market. People need to see cycles. All these things will temper and also function on investments. I should also mention that, of the millions of investors who sort of trade in the markets, a lot of them have fairly low trades. So that also is a function of India. Because we are such a giant country, we are a large country, there are various versions of truth that sort of come out. So on one side, we see more and more participation into our markets. So 3 years back, the average number of people who traded in the markets was about 40 lakhs, 50 lakhs. Today, that number on a monthly basis is 1.1 crores. This is the interest in the markets. But if I look at some of the studies we have done in terms of Gini coefficients, which look at what kind of inequality exists in these markets, you notice that the vast number of investors do not invest more than 10,000 rupees a month. Less than 10,000 rupees a month, in fact. So this is the sort of story that's panning out. And I would sort of re-emphasize this fact that interest in the markets, interest in equities as an asset class is a function of growth, is a behavioral trend as well, and also what you're seeing in other asset classes.
Thank you, Tirthankar. Bharat bhai, your experience has been galore, it has been mammoth. We are seeing that in this calendar year, the penny stock index has moved up by almost 90-odd%, 85, 90-odd%. Large cap index has moved up by 7-8-odd%. We have seen that 3 mutual fund schemes on the small cap side have stopped taking money. Everybody is only interested in investing in small caps. Is there any advice, because of your experience, because of your learnings through the market cycles, and especially large number of, as Tirthankar also mentioned, large number of participants have actually come post-COVID or during COVID. They haven't seen too many cycles. What's the wisdom you want to share for these younger investors, and especially in times when the differential between the large cap and the mid cap, or the large cap and the small cap, and the large cap and the micro cap, and the large cap and the penny cap is so much? Your wisdom.
No wisdom, but a viewpoint. One, time to time it is fashionable to talk about large cap and mid cap and small cap, almost like a mantra, as if that's a recipe for automatic value creation. I think value creation in investments or in businesses doesn't happen because something is a large cap or a mid cap or a small cap, but because it has certain traits and attributes which will help in creating value. Market cap is an outcome of those traits. Therefore, what is an outcome cannot itself become a source of returns being generated. I mean, if there are favorable business quality and management quality and size of opportunity and growth and the quality of growth attributes, there will be a value creation, and small will become mid, and mid will become large, and large will become larger. In absence of which, it will be the reverse process, and therefore there is nothing magical about large and mid and small. I think it is usually a very popular entertainment for investment community to keep time to time discussing these things. Secondly, not that I have many investments in small caps really, but as an observer, I do not find that there is any rupturous out of line kind of behavior even in small caps. Whether some people have stopped accepting money or not is their individual situation, individual portfolios, and what kind of names and things that they put in. But I'm looking at valuations in general. I don't find any outrageous behavior or any excessivity. I mentioned earlier when economy was on a relatively shallow ground, predictability was low, and bias was for near term. It reflected in low market valuations as well as in perverse investor behavior by buying low quality businesses or raising them to unsustainable kind of valuations in the hope of encashing quickly and running away. But as the opportunity belief is deepened and longer and more confident, I think the character of the participation, behavior of the participation alters. And I think we are roughly moving in that positive direction. Therefore, even though we as a house are not materially invested in any small names of a material amount or anything, but I don't find any relatively outrageous behavior. Third, over a period of time, there is nothing significant to point out that small cap as a category or mid cap as a category or large cap as a category is done worse or better or otherwise. In general, over a period of time, it still remains bottom-up stock picking, each individual name, irrespective of the market, irrespective of indices, irrespective of geopolitical, irrespective of macroeconomics, irrespective of trend, fashion, sectors, whatever. Ultimately, you buy individual businesses, and there is nothing to suggest there is any particular trend. Last point I'll say in the context of the earlier discussion, going forward, there are many reasons to believe that the relative equity yield will rise and relatively fixed income yield because of the decline of the cost of capital relatively will be lower, and therefore the delta between the two is in favor. This is in sharp contrast to the previous decades where fixed income yields in general were usually on rise and equity yields were uncertain and unpredictable and tempestuous and short term. Finally, I would say if retail investors are participating, I think we should celebrate because even a retail investor in this country is an entrepreneur. Ultimately, entrepreneurs create value in the business by intelligent risk taking. And if retail investors are taking intelligent risk, then we should applaud it as investors and entrepreneurs. If they're taking foolish risk, they will suffer and they'll learn out of that. But net, in my opinion, the participation of the retail is something worth applauding and raising a salute to rather than getting concerned about.
Can
Thank
I add
you.
something to the small cap?
Yes, yes,
Right.
please. Yes.
So while I agree with my old friend Bharat on that, ultimately it is bottom up that you have to look at. But as a category, small caps all around the world are riskier than large caps. I mean, that's a matter of data, and which is why it is always prudent to limit your exposure to small caps. You know, even as a PMS house, we will limit our exposure to maybe 20-22% of our total towards small cap, meaning we don't look at stocks below 1,000 crore market cap, but even 1,000 to 5,000, we would limit the exposure. And the reason for that, again, because many investors are coming in new, they don't know the history, is that there can be very dramatic falls in small cap, even at an index level. And how dramatic? In 2008-9, the small cap index fell nearly 80%, 78% to be exact. You had this, and that 2008 high was breached again only in 2016. You had a brief bull run in
83%, Devina.
2017. And
83% it fell in 2008-9, small
yeah,
cap.
yes. Sorry? 70.
I said 83% was the fall in
Okay,
8-9.
I mean, maybe we're looking at different indices. The index I looked at was 78, so 83 is worse than that. So, but I'm just saying that it never reached that level for another 8 years is the point. It wasn't even like just a spike. And then in 2018, again, it fell nearly 2/3, 65%. And this is like, many people will say that, but the stocks I am picking are going to be very good. But we also looked at that. So in the 2008-9 fall, what percentage of the small caps did not fall? Exactly 1%. In the 2018-19, what percentage did not fall? 8%. So, I mean, statistically, and I mean, as I said, I go statistically, what is the base rate? How likely is it that your portfolio is going to be in only that 1% or 8%? The other thing which people don't realize is that percentages are not symmetrical going up and down. So I see a lot of micro cap managers coming out of the woodwork now saying, my compounding for last 2 years has been, let's say, 60%. What people don't realize it, when the stocks, when an index falls 80%, you can go up 5 times and you are at 0. When it goes down 2/3, you can go up 3 times and you are at 0. And you're actually not even at 0. This is the other thing. In small cap indices, the index itself changes 18 to 20% of its constituents every year. So in 5 to 6 years, you have a different index. A few of them, as Bharat said, do migrate up to the mid cap and on, but a large percentage just go out of the market. They get unlisted. They are not to be found. I mean, in one of the previous panels, one of the panelists was giving that data on what percentage of listings happen and how many companies are eventually in the listed space after a few years. So those are the risks that you have to keep in mind, and therefore, since it's your hard-earned money, limit your exposure, do your research, but still limit your exposure. Because in small caps, unlike large caps, even with a stop loss, for example, you may not get an exit at all because the fall can be so rapid and the company can just disappear. So, you have to be cognizant of those risks, and that this is what the past history shows you. And always, whenever thematic funds and schemes start coming for a particular theme, you will see it is usually close to the peak of that theme, because that's when they can gather the AUM, and that's the real reasoning why they are launching the fund, not because it's a great thing for investors. The investors have this feeling of FOMO, that fear of missing out. Small cap ka run chal gaya, hum usme ghuse nahi, so now let me buy a small cap mutual fund. So there's always another bus coming along. So never think that ye bus chhoot gayi to you are gone.
Thank you, Devina. So be safe then, sorry. Wonderful words. Finally, one pointer, not answers, pointers. If one reform you would have wanted from the government, which has not happened in 9.5 years, and after 24 elections, if the current government has to come back, one reform from you and one reform from Tirthankar you, Rajni, and just one pointer.
I would say higher spending on human capital, which would be skilling, education, healthcare, and meaningfully higher.
Thank you, Tirthankar.
So she took my point. I wanted to say skilling. But second will be, please commit to net zero commitments. I think India's commitment to net zero by 2070, half of our power production through renewable energy by 2030 is the only thing that can save the world. There is no climate change, fight that's going to be ever won without India participating. So commitment to net zero will be our savior. It will also need to around $10 trillion of incremental investment. about $150 billion annually to India if the full numbers come true. So I will say, please commit to that.
I think we are on the right track because E20 is already there, right? Ethanol 20 is going to be there by 25. We have already achieved E10 in the early 2022. We exceeded the target. So there we are. So thank you, all the panelists. Thank you, Bharat Bhai. Thank you, Devina. Thank you, Rajni. Thank you, Tirthankar. Wonderful having you.
If you allow me, I'll just say the point to the last point that was being made. On the net zero commitment, India is the only country which is ahead of the curve. And there are only 3 other countries which are behind the curve, but it is reasonably close. Switzerland, UK, and Indonesia. All other countries in the Europe and America, which love lecturing about climate and other things, but really don't leave their part of the deal. While at least India is ahead of the curve, and there are 3 other countries which are behind, but at least working hard to be near there. Others vacillate and opine.
Thank you. Thank you. Rest assured, whether small cap, mid cap, large cap, Bharat is growing and Bharat's growth trajectory is going to be up and up and up. Thank you.